Hello everyone, this is Brandy Williams with an educational accounting and tax video. Please like, share, and subscribe to my YouTube channel. You may also follow me on Instagram, Facebook, and TikTok at WilliamsAccTax. On LinkedIn, connect with me by searching Brandy C. Williams Mac. Lastly, visit my website, WilliamsAccTax.com, to review my bio, read my blog, enroll in tax school, contact me, and schedule a free consultation. I look forward to hearing from you. Enjoy the video.
Do you qualify for QBI deduction? Qualifying business income deductions. Subject to certain conditions imposed under Section 199A of Internal Revenue Code. A portion of your business income may fall under qualified business income, or QBI, for tax deductions. This was introduced as a part of tax reforms under the Tax Cuts and Jobs Act of 2017. QBI defined by the IRS as the net amount of qualified items of income, gain, deduction, and loss from any qualified trade or business. Owners of pass-through businesses such as sole proprietorships, partnerships, S-corps, and certain trusts and estates are eligible to get tax deductions equivalent to 20% of their net income from these sources. The term pass-through relates to how these entities are taxed. As opposed to C-corps, which are taxed under corporate income tax regime, the income from these pass-through businesses is passed through to the owner's tax returns. Those requirements? The IRS has set out certain requirements which need to be fulfilled in order for an individual to be able to get tax deduction under the Tax Cuts and Jobs Act reform. These are briefly discussed below. Generally, all pass-through business owners are eligible for QBI as long as they fulfill the criteria of Section 199A, with a few exceptions. Major exceptions in this regard are as following. 1. Income from businesses that are located outside the geographic jurisdiction of the U.S. 2. Interest income that may not be accurately attributable to a business or trade. 3. Any sort of investment income, such as capital gains or losses or dividends. 4. Wage income. 5. Items that may not be properly linked to taxable income. 6. Guaranteed payments received from a partnership. 7. Payment received from a partnership in a capacity other than a partner. 8. Commodity transactions. 9. Foreign currency gains or losses. 10. Income from a publicly traded partnership or real estate investment trust. Similarly, QBI deduction may be limited or not available at all after a certain income threshold if your business is categorized as a specified service trade or business. A specified service trade or business may be defined as a service-oriented business, except architecture or engineering, where most of your income depends on goodwill or specific skill set of those involved, including both owners and employees. This is a very broad definition, but it usually includes medical practices, law firms, accountancy firms, financial service providers, portfolio management firms, and businesses related to performing arts. For a specified service trade or business owner filing returns, 20% QBI deductions are available till the income of $182,100 as a single individual and $364,200 for joint filers. The limits are doubled in case of a married couple filing jointly. Partial deductions are allowed for the income between $364,200 and $220,050, while no further deductions allowed for income greater than $220,050. Rental income qualification. While rental income is usually qualified for QBI, there are certain exceptions to it. These are summarized below. Rental property that is located outside the geographical jurisdiction of the U.S. Property that has been under personal use of the owner during the whole or a part of the year, such as those used as second homes or vacation homes. Rental properties that are on triple net lease. In addition to monthly rent, tenants are responsible for property taxes, insurance, and maintenance of such properties. Any rental income that has been generated from leasing agricultural land. In order for rental income to be qualified for QBI, the following conditions need to be met. 1. For each rental estate enterprise, separate records and books need to be maintained. 2. The owner must have performed 250 hours or more of owner-related duties, such as repairs, reviewing tenant applications, maintenance, plumbing, landscaping, etc., related to that property in a year. 3. The tax filer must have maintained all essential records, including but not limited to documents, logs, and time reports, etc. 4. Tax returns must be filed on time, and a statement pertaining to rental properties must be attached with it. For a non-specified service, trade, or business, you may be able to claim a full 20 deduction for whole income. Most business owners are too busy with setting up the business and running its day-to-day operations to research tax updates. Hiring a professional tax consultant to help you through all stages of filing and paying taxes is a reasonable alternative. A tax professional may also help you in minimizing your tax liability by using his or her experience and knowledge of various options available in the tax code.
This is Brandy Williams. I hope you enjoyed the video. Please like, share, and subscribe to the channel, and follow us on all social media platforms.